When a trade goes against you, it sucks, but it's completely normal. It happens to me all the time. That's why in this video we're gonna see how you can vol trade, so hopefully you can turn losers into winners. And especially in this video we're gonna focus on credit spreads. And if you've been trading recently, you must have seen that big down move that we had 2 weeks ago. And with that big down move, a lot of my long credit spreads went into a loss. So when you have credit spreads that are in a loss, the big question is, what do I do with those losses? Should I just close the trade and move on, or should I do something else? And that's where rolling comes into play. But the first thing to understand is, what does rolling mean? Because I feel that there is a lot of misconception around what does rolling mean and how it's done, so I really want to clarify everything in that video. And rolling is what we call a defense strategy. It's what we use to manage losing positions and hopefully turn those losing positions into winning positions. And to make you fully understand what the concept of rolling mean, I'm going to take one of my positions that I have, which is a losing run right now, and we're going to see together how we can hopefully turn that losing position into a winning position. Okay, so we're now in the Testworks platform, and all of those positions are the positions that I have currently open right now. So obviously with the down move that we had recently, all of my long positions, meaning put credit spreads and everything that is bullish on the market, obviously took a hit because the market went down. So I'd like us to look at the XOP position that I have right now, where my mouse is, and you can see that I have a put credit spread, and for the moment I have 31 days to expiration, and my short leg is in the money, but my long leg is not in the money yet. And that's what we call being on the dance floor according to Testy Trade, meaning that when the price is around your strike price and is going from being in the money to not being in the money, and that's what we call being on the dance floor. So as I said, there are several ways of rolling a trade, and when you have a credit spread on, the first thing that you should think at when thinking about rolling a trade is rolling out in time. So what does that mean, rolling out in time? It's closing your current position that you have and opening a similar one in a later expiration. So if I click on the long leg and on the short leg, you see that now they're highlighted, and then if I do a click right, I have several options that open, and you can see that I have roll expirations and roll strikes. So rolling expiration is going to be what we're looking for here, and roll strikes is more when you have an iron condor and you want to what we call roll the untested side. So if we go into the roll expiration, you can see that I have different numbers that appear. And you can see that I have all the different expiration, meaning that I have the 23rd of October, 30th of October, 11th of November, 20th of November, sorry. And you can see that we have numbers next to those expirations. And you can see that I have, for example, for the 23rd of October, 12 credit. So you see that I have the CR just next to the number, that means credit, and DB in red means debit. And now we arrive to one of the very fundamental rule of rolling a trade is we should always try to roll for credit. But what does that mean, rolling for credit? Let's imagine that you have a credit spread on and the width of the strike is of $1 and you collected, I don't know, 33 cents. So you have a max loss of potentially $77. That's the max loss that you can have. If you roll a trade for a credit, meaning you close your current position right now and you open a new one in a later expiration, and that is for a credit, it means that the later expiration position, meaning that the one that you're going to open, has a bigger value than the one that you're currently closing now. And what does that mean is that if you're rolling for a credit, your max loss is actually going to decrease and your max profit is going to increase. Compared to that, if you were rolling for a debit, it means that the position that you're going to open in a later expiration is worth less than the one that you're currently closing. And it essentially means that if you roll for a debit, your max loss is going to become bigger and your max profit is going to become lower. So you see why we would want to roll for a credit, because if you already are in a losing position and you want to manage that trade, you do not want to add more risk to that trade, because you're already closing your trade right now. It wouldn't make no sense to open a trade with more risk. And that's why we always try to roll for a credit, because at least you reduce the risk as you're rolling the trade. So you understand why we would like to roll for a credit. But those numbers are representing what if you were rolling the same exact trade at the same exact strikes but in a later expiration. Meaning that if I try, for example, to roll my trade, to close my current trade and roll it for the December expiration, for example, what's going to happen is that you see here that it's closing, it's selling to close and buy to close my 45 and 46 strike, and it's buying to open and selling to open the same strike but in a later expiration. And we are doing all of this for a credit of 12 cents. And what's really interesting to notice here is that you can see that my new max profit is of $38 and my new max loss is of $62. Compared to my initial trade, where if I clear the rolling trade, you can see that I have a max profit of $26 and a max loss of $74. That was not necessarily a very good trade that I've taken on this one, by the way, but you can see that when trying to roll my trade now, if I do it again, it is my max profit is actually increasing and my max loss is actually decreasing. So you can see that rolling actually really does make sense, and rolling for a credit really makes sense because as we are in a losing position, we're reducing more and more the risk and we're increasing our max profit more and more. And quite often, if we just give ourselves more time to be right, that is enough for the trade to come back and go into a profit. And that's what we call market cyclicality, meaning that we just bet that if we give more time to our trade, the trade is going to come back in profits. And I know it's quite weird to think that if you just give yourself more time, the market is going to come back, but it's in general what happens. And that's why rolling is a very good technique. And personally, when I was starting options, I was like, no, I don't need to roll trades. If I'm right, I should be right away. But the truth is, it doesn't work like this. And I wish I could be right away all the time. That would have saved me a lot of money. But the fact that we are not, and the fact that we can use that rolling strategy as a defense strategy so as to manage our trades is a very good thing. And you really need to learn how to do this actively. You really need to be engaging with your trades and to roll them if possible. The more comfortable you get at rolling trades in a later expiration for a credit, the more you're going to be able to turn those losers into winners. Because you need to take into account that you're closing your trade right now, meaning that the P&L that you have right now, and I think for my XOP position, I'm around minus $12 right now, if I'm not mistaken. You'll tell me in the comments if I'm wrong. But the fact that you can reduce your loss already by rolling the trade and giving yourself more time and possibly having the trade coming back in your favor is a lot better than just taking your loss and moving on. If you can squeeze profit out of that trade, go for it. And if you still believe in your trade, if you still believe that it can come back, well, do it. And have a set of rules that I personally follow so as to know when to roll the trades and when not to roll the trades, because it's very tempting to roll trades all the time whenever they go into losers, but you should learn also how to give time for your trades to be right and just let the time do its thing. And those rules are mainly coming from Tasty Trade, meaning that I often roll my trades when they come around 20 days to expiration, meaning that if I have any losing positions and we're 20 days expiration, I will roll out those trades in time. And another thing that you could do so as to roll a position is if you have a credit spread on, meaning whether you have a put credit spread or a call credit spread on, you could sell a corresponding put credit spread or call credit spread depending on what you have already so as to create a short iron condor. And when you're going to sell this corresponding put credit spread or call credit spread, hopefully you're going to do it for a credit, and that is going to create a short iron condor that's going to have as an impact to reduce your max loss and increase your max profit. Let's go into the computer and let me show you how to do that. Okay, so let me show you what would happen if I was selling a corresponding call credit spread, because I have a put credit spread on, but I could also turn my put credit spread into a short iron condor so as to roll my trade and hopefully make a profit out of this. So if I go into XOP, you have to go into the expiration where you are, and then what happens if you, for example, sell a corresponding call credit spread on that. So what is happening now is that you see that I have an iron condor that is on right now because I'm selling a call credit spread and I have already a put credit spread that is on. And what you can see is that my max profit now at expiration is of $53 and my max loss is of $47. And you do not only have, you can also change the strikes that you have, and you can see that I'm rolling for a credit of 27 cents. So I've chosen those strikes completely of pure hazard, but I could make it a bit wider so as to widen my profit zone. And selling a corresponding whether put credit spread or call credit spread depending on what you already have on is a very good way of managing your losing positions. And if I was, for example, going for the 52 strike and 51 strike, you see that now I would collect 36 cents and my max loss at expiration would be around $61 and my max profit at expiration would be of $39. So that's a pretty good ratio, and I could definitely do this to roll my position. So you see that you have different ways to roll a position. You could close your position and open a similar one in a later expiration, all of this for a credit. You could also sell a corresponding call credit spread or put credit spread depending on what you already have on so as to create a short iron condor. you have different ways of rolling your positions so as to turn hopefully losing positions into winning positions. However, there are some pitfalls that I see very often people are falling into that I really want to warn you about, because this is important when you're running trades. And the first pitfall that I see people doing, especially with risk-defined trade, is that they are going to widen the width of the strikes. What does it have for effect is, yes, you're going to roll for a credit essentially because you're collecting more. However, you're also increasing your max loss. And that's something that you do not want to necessarily to do. If you're rolling a trade, it means that you already are in a losing positions, and widening the width of the strike, meaning you go from $1 width to $2 width, you're increasing your max loss by potentially $100. So that's not nothing, and that's not something that I recommend you at all to do, because you're already in a losing position. So don't add risk to the positions that you're rolling. Just roll them for a small credit if you can, and if you can't, maybe it's just worth taking the loss and moving on. So you see that you do not only have to roll trades whenever you have losing positions, you also have to ask yourself, do I still want to have this trade on? Is my assumption still the same about this trade? Do I still believe that it has a chance of going into profit? Those are questions that you need to ask yourself. And it also comes down if you have more implied volatility, and the implied volatility, for example, for a stock that you have sold a credit spread on just shot up all of a sudden, and now option prices are super high. That's potentially an opportunity for you to roll a trade, meaning closing your position right now and opening a new one in a later expiration so as to benefit from that implied volatility that went up. That's something that I do very often. I had a trade on JD that was in a loss, and then suddenly the implied volatility was in June. The implied volatility shot up, and what I've done with that is that I've closed my trade and I opened a new one in a later expiration with all that implied volatility that was there, and I've done that for a credit overall, and that was a very, very interesting move, because after that I could benefit from the implied volatility contraction. That's why you're definitely going to benefit from the implied volatility video that I've done, where I try to explain everything, and I hope that you're gonna understand how it works so you can benefit after that from rolling positions, for example, when the implied volatility is high. Thanks so much for having watched this video, and in the meantime I wish you all the best.